Welcome back, everyone, to another edition of Diamond's Edge. My name is Greg Diamond, editor of 10 Stocks Trader at Stansberry Research. And this week, we're going to look at inflation picture. We're going to look at bonds and why I think we're at an important inflection point for bonds. Obviously, if we're at a inflection point for bonds, what could that mean for stocks? So let's go ahead and get started. I've looked at the correlations between interest rates and bonds a lot this year. And let's turn over to this chart right here. And as you can see, this is just pretty much the next week or so of important fundamental economic catalysts. Okay, and you can see here GDP comes out, and then the Fed's most important, or what it deems to be the most important gauge of inflation, is the PCE deflator. And then even we have ISM, heading into next week, and then in the middle of June is the Federal Reserve's next meeting regarding the future rate of inflation, what their policy, what they're going to do or not do. So this is going to be important. There's no doubt about it. All right. Now, aside from what comes out here, obviously those will be important as well. But let's look at this from a technical perspective. Okay. And this is the U.S. 10-year interest rate. All right. And it's really pretty simple. I don't have any Elliott wave counts or anything like this. But what I want to show you here is, okay, we obviously had this big drop last year, which led to a big rally in stocks, okay? And now we've kind of chopped higher, but we haven't made a new high. And we saw some volatility around a rise in interest rates with stocks, particularly in April, okay? And so what we're looking at now, and I want to zoom in on this, all right? So as you can see, heading in, into May, we dropped below this level of support, okay? And now we're starting to bounce back. Now, as you can see, as of Monday here, this is interest rates are struggling to now break above the short-term resistance. So I have three arrows here. Obviously, last week marked the high. Can it rally a little bit higher into, call it just shy of 4.6%? I have a symmetrical here in blue, which would get to about 4.55%. All right. But this is kind of the short-term outlook I'm looking for. Again, if we factor in GDP, the PCE, ISM. So, if we see it bounce up here and then we start to trade back lower, that could be a sign that this whole move is now over. All right. And then we can see another drop in interest rates. If we see a drop in interest rates, that's going to be really good for stocks as well. All right. So this is kind of the short-term setup that I'm looking at. So let me show you what the long-term setup is actually going to look like. And I'm using this as bonds. So the TLT, the iShares. All right. This is a short-term setup. Again, it kind of mirrors what's happening in interest rates. Bonds bottomed and then they rallied. Can it start to break above this short-term resistance level? If it does, this is probably a spot. It could basically unleash the floodgates of interest rates rising and bonds rallying. And then if bonds rally, at least in the short term, stocks are going to like that as well, as we've seen that correlation since the top in 2021, 2022. Okay. So this is something where I'll look to buy this breakout. Okay. Yeah. It might, you might have some type of a fake out, where, maybe it breaks out and then it comes back and then it keeps going, or even it breaks out and then comes back lower. All right. It's still a good, from my perspective, a risk reward setup to own TLT or even a triple levered ETF based on TLT, and if we were to get, let's say this resistance holds and we get a drop, so it would look something like this. Let's see, like this, right? And then we start to rally. This is a situation where I would probably get aggressive with call options. Okay. All right. So those are the short-term factors, or outlooks rather. Now let me show you what I'm looking at on a long term. All right. And this is getting a little bit more into the weeds in terms of Elliott wave and things like that. But I think this is worth pointing out in terms of, the long-term outlook. And so from here, you can see this is going all the way back to 2006. All right. And you had this, not a steady uptrend, but bonds for the most part rallied. Inflation was at near 2%. Obviously that shifted a little bit. Okay. But, everything was kind of boring, if you will. All right. We obviously had the run up into COVID. and the mistakes that the Federal Reserve, Treasury, government in general made by printing gazillions of dollars, trillions and trillions of dollars into the economy that resulted in inflation, which is why we're here right now. All right. And you can see this reflected in the price of bonds. All right. So let's take it from the top, and you can see here that I have, a larger 1, 2, 3, 4, is this low, okay, from last year, the low. Now, that's always a hard thing to do when we've had, a 3-4 year downtrend. Okay, is to say this is going to be the exact low. But so I like to have a little bit of a conservative outlook and say, all right, at a minimum, what can we look for? And at a minimum, and this is something I outlined to subscribers earlier on Monday, is that we could have this move here in blue, which is just a minimum move of around 15% in TLT. It rallies up. And then you kind of worry about what happens afterwards. But to take advantage of this long setup is pretty good. All right. So what I also want to show you is how this could look if the conservative move isn't there. So this would be something like this: 1, 2. This is the bottom of a 3. Okay, and then this is a 4. Yeah, and then maybe we get a bigger 5-wave move down into, call it sometime in 2025 after the election. Who knows? Okay. That would be the conservative look. The other thing, and you can see here, I have these 2 red boxes, is that these would be bigger resistance levels where we could actually see something like this happen. Okay. Where you actually get a much bigger move that confirms the bottom. Okay. That would be important. So this would be a 5, and then this could start a 1, 2, 3. So it would look something like this. Let me, I just want to show you so it can, so this would be 1, 2, and then we have a big 3rd wave move up. Okay. And then, it looks something like that, where, we actually do see the bottom in interest rates. And this would obviously be a huge boon for stocks. Okay. Now, the other side of the argument is that if inflation is actually starting to come down, and maybe the Federal Reserve starts cutting interest rates, well, this is a sign that the economy may be weakening. 100% agree with that. I don't doubt that for a second. But that's probably 12 to 18 months out. So what we would have in the beginning is saying, hey, interest rate environment has actually changed. This is going to be good, at least in the short term, because interest rates are going to come down and stocks are going to react positively to that. Now, after a few months, 6 months, 12 months, whatever it might be, if indeed inflation is coming down because the economy is cooling off and not as robust as some might think, yes, that's when you see an increase in bond prices probably start to be priced into stocks like, hey, this is actually a bad thing. But in the short term, this is what I'm looking at, and just in terms of a trading setup that I think is worth noting. So we looked at the short-term setup. If it starts breaking above those resistance levels, that could be a flood into bonds, which would be good for stocks. And in the long term, I've outlined the conservative count as long as a more aggressive count about how to look for more upside on bond prices. So we'll see what happens with all the rest of inflation data this week, and then obviously how the Federal Reserve reacts to this. But this is a setup I'm looking forward to trade over the next couple of months. Thank you.